Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back, episode 115. Ryan and Sonu here, Carson's Facts versus Feelings. Sonu, this was a fun title. Did the Fed kill Santa?
Ouch.
Oh, I know. We're just doing that for the... Hopefully the algorithms like that one. I don't know, a little strong, but we're bringing it. So you, on the YouTube channel, by the way, we had a lot of YouTube views last time. We are starting to share more charts, trying to be more interactive with what we share visually on the YouTube channel. You're not at your regular spot. Where are you sitting right now, Sonu?
I'm in Naples, Florida, and, the sun coming in. It is bright here. It's not just my camera and this, camera setup that I have that's making me look brighter than normal. I think, I booked up because, it's 75 degrees here in Naples, Florida, and I'm not in, 20-degree weather in Chicago.
So I'm in Cincinnati. It's going to be pretty warm the next several days. Chicago was, and we're talking now by pretty warm. I'm talking like 50s, but hey,
that's pretty good.
I remember Christmas Eve. I guess it would have been 2 years ago because it's right when we moved back to Ohio. That was like -10. That was a really cold one. So we don't have that problem.
Yes.
But you had fun getting there, right? At the airport, right?
Right. This is what I did. 4 hours late. It was only 4 hours late. So thankfully, the flight took off. We really considered, this was last Saturday. So whatever date that was, right? We're recording.
And whatever day this is, who knows?
Yeah. Today's 23rd of December.
Okay.
But yeah, I think it was 20th. But yeah, the flight is 4 hours late. That's the last thing you need when you're traveling with kids. But, we survived. And I sat at the airport thinking about, what did we get right and what did we get wrong, 2024 outlook. So, that's what I do with my free time.
Well, it's funny because you said, I'm going to the airport. I knew you were cut off. And next thing I know, you're sending like a ton of emails, like thoughtful emails. I'm like, what's this guy doing? Like, I thought he was supposed to be at the airport. Then it made sense when you told me this morning we were 4 hours delayed. You were just trying to get some work done.
By the time we got into Florida, it was past midnight. So.
Oh, boy. I'm glad you made it and enjoy. And let's just dive in, right? Again, episode 115. Sure. 115, did the Fed kill Santa? We're going to talk about the Santa Claus rally, about the markets, which have been extremely weak-ish lately, what could happen the rest of this year, then spend a good amount of time on that Fed decision. We've had multiple days to think about. Honestly, we're still a little bit confused. So what exactly happened? But we're going to talk about that. And then one of my favorite charts, income still strong. We're talking about a little bit of incomes and putting it in perspective with inflation and things like that. All right, so again, on the YouTube channel, we're going to put an image up. Drew will put this up. They don't ring bells at the top, but as you can see on the YouTube channel right now, we literally just last week had President-elect Trump ringing a bell at the NYSE. Now, where I'm going with this is markets have been weak. We talked a few weeks ago, David Rosenberg kind of threw up the white flag a little bit for being a bear for the last 15 years. You look at the Global Fund Manager Survey, Bank of America, like the largest overweight to U.S. stocks ever, smallest underweight to cash ever. What else? I mean, there's more stuff.
Yeah.
There's more stuff. But listen, being bullish now is kind of like cool, kind of normal. Whereas 2 years ago, you were hated. And we know because we were hated 2 years ago for saying, you know what, things might be okay. They don't ring bells at the top. Did they just ring one? Did President-elect Trump just ring one, Sonu?
I don't know. Like, we've talked about this. In fact, we wrote about this, and part of this will be an outlook without giving too much away.
Yep.
That there are, we think next year will be positive. Okay.
Yep.
And part of that is we think there are policy opportunities there. Fed cutting rates, tax policy, all of that from the new administration. And that's all going to be tailwinds for the market, potentially opportunities. Now, we were clear that we didn't think it's a certainty that these things would happen. What happened last week was a reminder why the probability of both of those things was not or is not 100%, right? Yep. The Fed is not guaranteed to cut rates. They may sit on their hands on a pause for a good amount of time going into 2025. And we saw from all the craziness that happened related to a shutdown, we didn't get a government shutdown. But the fact that, House Republicans are having a hard time passing anything, that just is a reminder that, tax policy next year is not going to be very easy to do. It's never easy to do.
No, it's not.
Right. And then on top of that, you have this crew. So, I think we're going to be sitting on our hands. You said it best, I think, several weeks ago. Brace for some volatility. We haven't seen a lot this year. And boom, here we are.
I was excited. What did I say? I said, what in the world did I say? But that's true. So, listen, let's put some context around things, right? We had a 10-day losing streak on the S&P 500, longest since 1974. 14 days in a row, value stocks. Now, by value stocks, that's looking at the IWD, not a recommendation, but that's at eValue 1000 ETF, Russell 1000 ETF, down 14 days in a row, all-time record. What else do we have? The S&P 500 had a record 14 days in a row. At least I've got data back to 1972 from our friends over at Ned Davis Research. This is records in 72 at least. 14 days in a row, more decliners and advancers on the S&P 500, tying the longest streak since 1978, the year Sonu and I were both born. Let's see here. What else do I have? RSP, that's the equal weight S&P 500, down 14 in a row. Because if you look at just the S&P, stocks are doing okay-ish until Wednesday's bloodbath, which we'll talk about the Fed soon. But again, equal weight down a record 14 days in a row. Previous record was 12 in December of 98. And then we also had nearly, depending on your source, but I've seen over 70% of stocks in the S&P 500 made a 20-day low just last Wednesday. Now, let's talk about last Wednesday for a second, Son, and I'll go to you. Less than 4% of all the stocks in the S&P were higher on the day. The Dow, wrong one. The S&P lost like 3%. That was the Fed. We'll talk about the Fed. Obviously, market didn't like what they said.
Down 4.4, I think.
4.4. I mean, there's more. Where is it?
I think it goes down.
Let's see here. 97% of all the stocks in the S&P 1500 were down. Now, here's a little trivia for you around the holidays. There's 1,502 stocks in the S&P.
I thought you were going to ask me to calculate in my head what's 97% of 1,500.
Close enough. It's according to this 1,467. 483 stocks were down in the S&P 500. 396 were down in the S&P 400. That's mid cap. And listen to this: 590 down in the S&P 600. That's small caps. I mean, it was a bloodbath. Then on Friday, we had like 89% of all the stocks in the S&P 500 higher, had a decent-ish bounce back, still down on the week. So I just said a lot there. What do you want to talk about from more of a markets point of view before we dive into the Fed there, Sonu?
We'll talk about the Fed, but let's talk about Friday. For one thing, usually something big like that happens. First, what's the first thing I imagine you're looking for? Probably me too. Is that do we get a bounce back on the next day?
Yep.
Usually more often than not it tends to happen, but we didn't get that on Thursday.
Right.
Friday comes around, we get that, but now it comes about on the back of lower than expected inflation data. We get the Fed's preferred inflation metric, the personal consumption expenditures index for November. That headline and core PCE inflation came in below expectations, up to 0.1% month over month. And it was nice that it was kind of ironic too that here the Fed's all freaked out. Pardon my language for using that, but I think it's fair to say they were all freaked out about inflation. We'll talk about that. And then 2 days later, their own PCE metric comes in soft, and the market takes that as a good sign, which is great. And I think there was a rally that we got, right, which went into the rest of the day, went across the rest of the day, across the board, right, even for small caps, mid caps, everything. Now, my worry is because of what the Fed did going forward is that suddenly the markets once again, I thought we had done with this, right? The markets again geared to inflation data. What are we doing here? Now, you and I talked about this last week, why we don't think inflation's a problem. I think we laid out a very good case for it, not just based on backward-looking data, but even forward-looking expectation stuff, consumer expectations, business expectations, market expectations, all of that. Nothing tells me that inflation's, anything to worry about. If it's sticky around 2.1, 2.2%. Close to the Fed's target, but here we are.
And that's where we were in 2019 when things were pretty normal. We weren't at 2, we were a tad above, right?
Right, exactly. And then now suddenly the market's again geared towards watching and reacting to inflation data. My worry is, we talked about this and wrote about this, that come Q1, for methodological reasons, nothing to do with reality, sometimes goods inflation tends to be harder in Q1 for seasonality adjustments, things like that. You get higher used car prices in the data, in the official data, higher new car prices in the official data, all of that. So we know that's coming. and the market's already overreacting maybe because of the Fed. I don't think it's a market fault.
Right.
But the Fed's led the market to, gear towards inflation data. There could be some harder than expected inflation data coming in. And like I said, brace for volatility then.
Well said there. And we'll probably dive more into the inflation data near the end, but that's a good context around things. Friend JC Peretz at All Star Charts, he's pointed out, though, if you look at how many stocks making new lows, there's really not a lot, right? Over like stocks making 3-month lows, it's a little higher, but it's by no means soaring. So that's some important context. Also, I looked Sonu at previous long streaks of more decliners than advancers on the S&P 500. Again, we just went 14, record 14. Go back to 1990. There's 1, 2, 3, 4, 5, 6, 7, 8 other times we had at least 8, which is, we just made 14, but 8's still an awfully lot. 1 year later, higher every single time except once. Okay, up about 14% on average. What's interesting, though, the next month, 3 months later, you get pretty strong returns also. So we're hearing about this weak market breadth being a warning sign. And I wouldn't totally disagree by hearing that, but then you take a look at the actual data, and it's not quite as worrisome as they'd make you think. Now, one final thing, Sonu, I do want to talk about Santa. Fear is in the air. All right, I just mentioned some optimistic things, joked about ringing bells at peaks, but the VIX saw a massive spike. And I'm not a big fan of VIX in percentages, I want to be clear, but nonetheless, on Wednesday, the VIX spiked, I believe it was 67%. Which is like the second highest percentage spike ever, but still the VIX soared, even on an absolute basis. We saw some movements in put-to-call ratios. There's something called the CNN Fear and Greed Index, which is showing the most fear we've seen since when? Since early August, when we had the yen carry trade unwind. So, we are extremely oversold. You look at stocks above their 10-day moving average, stocks above their 20-day moving average. It is in flush-out, wash-out material, and here we are about to turn the page to what historically is a pretty bullish time frame. Now, here's a few things, Sonu, I want your opinion. These next 7 days, so starting on Christmas Eve, and the next 7 trading days, including Christmas Eve, is known as the Santa Claus rally, right? Yale Hirsch found this many, many decades ago. Everyone says December is the Santa Claus rally. No, it's these 7 days is widely known as the Santa Claus rally. These 7 days, Sonu, we're down last year. Let's be clear, we're down last year, but up the previous 8. These 7 days are higher 78.4% of the time. No possible 7-day combo is up more likely to be higher. So these next 7 days, as oversold as we are, they should bounce. Also up about 1.3% on average. It is the third best return out of all possible 7-day returns. But I like to say it's more of a clue when Santa doesn't come to town. Again, let's be clear. Santa didn't come to town last year. Stocks were down a little bit. Clearly, we had a really good year. So that's obvious. But if you go the previous 1, 2, 3, 4, 5 times, Santa didn't come to town back to 2000. It wasn't good, right? The S&P 500 was down in January every single time. Not all that great in the first quarter. And you had negative returns in 2000 overall. Big time negative returns in 2008. Remember that? No Santa in 2000, no Santa in 2008. Also 2015. Stocks were down in 2015. And then in 2016, Santa didn't come. 2016 was one of the worst first 6 or 7 month rallies or starts ever to a year. Then we did come back. Sure. But again, that maybe there's some clues, small sample size, sure. But I guess to put a bow on this, we are oversold. There is some negative sentiment, some things that are saying we're in a flush out here where maybe we start to get upward bias. We should bounce right into the end of this year. If we don't, that could be a little bit of a clue that this time is different, but it'd be a warning sign. All right, so did the Fed kill Santa? That's the question, Sonu. Go ahead and chime in here.
I hope not. I am trying to think back to 2018. Mm-hmm. Not great memories of what happened going into Christmas Eve, I think, was the bottom there.
That was
Christmas Eve was rough, and it's only like a half a trading day or something like that. But remember, at that time we had the whole tariff thing was going on already all year, but still, right? It sort of like really accelerated in December, and it was a tight Fed. I think the Fed kind of pulled the rug back then. Yep. They started to get too tight. But one thing, and this is where I'm thinking about, okay, what could come ahead, right? We know what the Fed just did. And we know Congress and things like that. But looking ahead, okay, let's see if we can learn some lessons from, or, learn what happened in 2018. Now, 2018, going into, after Christmas Eve, everything rallied into the first quarter of 2019.
Now, let me just chime in, Soto. We owe almost a bear market. In a period of like a week and a half, we almost had stocks down 20% because the Fed didn't cut. The market wanted to cut. Market threw a fit. There you go. And it was pretty darn frightening. Christmas Eve on 2018.
That V-shaped recovery, and I think, but a big catalyst, I think, was the Fed coming back and Chair Powell coming back and saying, "Oh, you know what? We may have goofed here."
Yeah, sorry.
Right? Yeah, sorry. You're calling an audible, or if that's even the right football metaphor. And what do I know?
I think so. Yeah, I think you did a good job there, Sonu. Great job. Do you know the quarterback for this Kansas City Chiefs? Let's start there. Do you know that?
It's not the Taylor Swift guy's friend.
Oh my goodness! It's Patrick Mahomes. We're not there yet, Sonu. We're going to work on this.
Yeah. You tell me Kansas City. I'm trying to think Taylor Swift. Odell Swift.
Yeah, there you go. Patrick Mahomes. He's kind of good. So I've heard. Anyway, yeah.
There you go. But I don't know who the Bears one is, and
nobody does. It doesn't matter. No one knows.
No, I suppose.
Yeah.
Anyway, no, the Fed changed that too, right? And they didn't cut rates immediately, but they kind of signaled, I think, January, February of 2019 now, that, cuts are coming. I think by the time the cut came, it was June. So we had that going for it. Markets are looking forward. This time, I don't know, Ryan, that they call, I think all of them are sort of committed to the fact that, you know what, we've cut rates by 1 percentage point, 100 basis points. Let's pause. Let's wait. We are worried about inflation. We're frankly freaked out about it. So, we're going to wait on our hands for some time, and the rest of us are also going to wait on our hands.
Well, clear as mud. So we've got another chart Drew's going to share right now. It said, should you really believe in Santa? And when you are positive during these next 7 days, the whole next year is up 10%, 10.4% on average, higher 73% of the time. Both those a little bit better than the average year. But again, when Santa doesn't come to town, the full next year is up only, air quotes, only 5% on average, and higher only about 2/3 of the time, as you can see on that chart there on the YouTube channel. So again, just something to think about. But I definitely want to dive more into the Fed, Sonu, because you shared some charts to talk about. What else before we go there? Yeah, I know. I'm going to try and get you canceled in 2025. That's my goal. But before we go there, what so the Christmas? So you're hanging out with the in-laws? Is that correct? You have the in-laws down in
in-laws, and we're going for a nice dinner, I think, Christmas Eve. So good. But most of the time we're going to spend it at the pool here, so that's nice.
Yeah,
last house with a big pool. And
sounds good. We went to IHOP last year for Christmas Eve. Just our 4 or 5.
Is that a tradition?
No, but we might make it one because it wasn't crowded. We went all dressed up. My wife always gets us, I don't know, the PJs, new PJs. So we wore our PJs. Now last year, my daughter, who at the time was 16, now 17, she refused to go, because we all looked like idiots and we're IHOP on Christmas Eve, but we thought it was fun. And we're gonna do it again. I don't know if she's gonna go or not, but that's okay. But that's what we're playing.
She's like, I don't want anything to do with this family. It's not my.
Well, it's not just that. It's everything. It's because I breathe the wrong way. But we can talk to a psychologist about that later. I do everything wrong apparently.
I can pick my wife, and no, I was kidding, but we don't want to do that.
It happens. Those with 17, 16-year-old daughters, you know what I'm talking about.
I think I'm already at that with my 8-year-old daughters. So, I don't have to wait till 16 or 17.
It happens. But so anyway, again, Merry Christmas, everyone. Happy Hanukkah. Happy holidays. Thank you to so many people that listen to us.
If you want to hear the latest from us, don't forget to subscribe to our podcast. Hopefully you know the name because you are listening to this Facts versus Feelings. You can also leave a review, and we love your feedback. Feel free to send us an email at Facts versus Feelings at VS for the versus, Facts versus Feelings at carsongroup.com.
There we go. Yeah, it's weird. I've got there's the chat feature. Okay, it's over to the right. I think they moved it on me. It used to be a different spot. I'm a creature of habit. But thank you, Sonu. Thank you to all the people that are listening. We do also have a mailbag that we've been getting some activity to. Facts versus Feelings versus VS, Facts versus Feelings at carsongroup.com. Feel free and send some things there as well. All right, so let's talk about that Fed, Sonu. I mean, maybe let's help Drew which chart you want up. I mean, I love the one about the number of people that are worried about inflation going from 3 to 15. You want to start with that one, maybe?
Yeah. So what did the Fed do? Well, they reduced rates 25 basis points. Now the Fed funds rate is between 4.25%, 4.5%. Nobody couldn't care. Nobody could care less about that, the fact that they drop rates that day, right? The thing was, everyone was focused on, even before the meeting, we talked about it. What are they going to do with the dot plot, the summary of economic projections? Remember, if you go back to September, that was very dovish, right? They projected more rate cuts in 2024, in 2025. This time, they just pulled the right from all of that, right? The 2025 rate back in September was projected at 3.4%. It's right now at 4.4. So you think about like 100 basis points of cuts or 1 percentage point. At this update in December, they raised it to 3.9%. So instead of cutting 4 times, they're going to cut only twice. And the median dot went up from 3.4 to 3.9. But I think all the members, that was a crazy thing, right? It skewed much more hawkish in December than it did in September. And it would be one thing, okay, if the Fed projected, okay, 2 less rate cuts in 2025, 2 fewer rate cuts in 2025. And they said, oh, you know what? We're just going to push that out to 2026. So, previously they were projecting 6 cuts across 2 years, right? If you said, you know what, we're going to do 2 in 2025, 4 in 2026, I think that would be one thing, but we didn't even get that. They said, we're going to do 2 in 2025, 2 cuts, and then 2 cuts in 2026. So they didn't push back, how you want to think about it, the missing rate cuts to 2026. I think that was, basically a rug pull. And then you think, okay, why did they do this? Well, they're concerned about inflation. Their 2025 projections of core PCE, personal consumption expenditures index, like I said, that's the one they focus on. That was raised from 2.2% to 2.5%. By the way, that is a big move. That's a big shift, right? 2026, they raised it from 2% to 2.2%. They're expecting to hit their 2% target only by 2027, which begs the question, Ryan, why are you even cutting rates if you expect inflation to be above target in 2025? In fact, even in 2026, Powell sort of gave an extremely mealy-mouthed answer. He basically didn't answer it too well, but trying to dig in, parse his words. I think he basically was trying to say, policy is still going to be meaningfully restrictive, right? Now, the members also think, so that's one side, they upgraded their expectations for PCE inflation, which I don't even think is correct, but what do our markets think of what I care? It matters what the Fed cares. But the members also think there's much more upside risk to inflation, right? So they come up with these projections. One is inflation uncertainty, and the other is inflation risk, upside risk versus downside risk. Back in September, 8 out of
and this, we'll time out 1 second. So explain it. This is one of the charts we're going to share, right?
Yeah,
just
yes. This should be on screen right now.
Explain that, yeah.
Right?
All right.
Both of these projections that they made. Yep. So inflation uncertainty, right? There's 8 out of 19 members in September thought inflation uncertainty was higher. And 11 thought it was balanced. Fast forward to December, now 14 of 19 members think inflation uncertainty is higher. Only 5 think it's balanced. Then you think about inflation upside risk versus downside risk. Back in September, right, just 3 out of 19 members thought inflation risks were weighted to the upside. In December, 15, from 3 it went to 15 of 19 members now think inflation risks are weighted to the upside. These are big shifts within the committee. And what's confusing is that Powell said, oh, we're not going to worry about 2 months of higher inflation prints, because we did get 2 harder than expected inflation prints in September and then in October. November was softer, and they already knew that. But I think they did that. They overreacted to 2 months of higher inflation prints. And I think the Fed's also worrying about, maybe it's a shot across the bow to President Trump.
Yes.
They're worried about tariff risks. Powell did say, look, most of us are not accounting for tariff policy in our projections, but it's hard to look at those inflation risk projections and say anything but. And Powell himself said that, look, there's so much of uncertainty about tariffs. Will tariffs happen in the first place? How much of tariffs will he get? On what goods will he get tariffs? And what's the impact on that, right? If the dollar is going up, first of all, you and I have talked about, maybe we don't get a big inflationary impact, from tariffs. So all of this is floating in the air. It leaves me very confused, but that's just me.
So, no, you're right. I'm with you there. I mean, great context. And it is true. I mean, we just saw, again, the number of Fed members that are worried about an upside move in inflation go from 3 to 15. There has never been a spike like that in only 6 weeks. What happened in those 6 weeks? Did we really see spikes in inflation data? I don't think so. I mean, we talked about it essentially. It was, we have a new president coming in, and I guess there's some worries down that rabbit hole. Now, here's an interesting thing I saw over the weekend. Looking at inflation expectations based on political party. I believe it was Bloomberg survey. Democrats, this is year-over-year inflation data.
Okay.
Expected 3.1. I'm sorry. It was 1.5. Now they expect inflation to go to 3.1 year-over-year. This is just in the past month. So again, since the election. Republicans. 3.6 what it was before. Now they expect inflation over the next year to be 1.3%. So you can see this, where it's going. And then the independents, as the truth is usually somewhere in the middle, they went from 2.9 to 3%. So, absolutely, the other way around, 3% to 2.9%. Virtually no change.
You were saying they're expecting about 2.93%. That's consistent with the Fed's projection target of 2% PCE inflation. Because even before the pandemic, it was about 2.83% is what consumers normally think inflation will be. So, it's not like these are abnormal numbers. I mean, ignore Republicans and Democrats. Take the independent piece.
Yeah. But I mean, listen, we follow it. We're going to keep talking about it all next year on the Facts versus Feelings podcast. But it does seem like, maybe there was some politicalness coming. Is that even a word? Politicalness? Political things jockeying. Coming in. Yeah, jockeying that, And I mean, I forget who said it, but somebody smart that I respect said maybe Powell just came out hawkish just so we can drop it next year, just to get some bad stuff out of the way. I don't know. I mean, maybe there's a little bit of room now. I know the Fed said, maybe 2 cuts next year, but the market, right? Mr. Market is saying there might only be 1.5 cuts next year, right after that reaction. Is that correct?
Yeah, and not just that, markets don't think the Fed is going to cut even after 2025. I mean, the Fed expects to cut a few cents off.
Oh, yeah.
Markets are not expecting any cuts, period, after 2025, right? Now, this gets to actually, the glass half full look here. Why did they revise their estimates, higher? And part of it is a good story, right? They're expecting better economic growth. The Fed projected GDP growth for 2024 to be 2.5%. That's upgraded from 2%. 2025, they moved from 2 to 2.1%. Nominal GDP estimates for 2024, 2025 moved up from about 4% to above 4.5%, right? It takes a lot for the Fed to move these growth estimates higher, but it tells you that that's part of the story here. It's for a good reason that they're upgrading forecasts. Now, I think they're sort of misguided with respect to why they think inflation will be higher. I think, especially when shelter inflation is, expected to pull back, continue to pull back. We've seen that already. But anyway, it is what it is. The other part, which is positive, was that they did lower their unemployment rate expectations for 2025 from 4.4% to 4.3%, which means what? They've lowered the threshold to act if the labor market is at risk. Say if the unemployment rate goes to 4.3, 4.4%, maybe they say, you know what, we are going to cut more. And just from my part, Ryan, I think they cut more than twice. I mean, maybe 2 to 3 times. I don't think I don't think we're in a scenario where they don't cut at all. Now we just have to maybe wait till June for them to start cutting. Okay. I think we get that, right? It's not, I've been of that view even 3 weeks ago. Now, the other thing I was sort of confused about with the Fed is that, yes, they're projecting higher, stronger growth, lower unemployment. But Powell said, look, we don't need further cooling from the labor market for inflation to fall. He explicitly said the labor market is not a source of inflationary pressures since wage growth has pulled back. And the labor market is actually now less tight than in 2019. But then, wait a minute, Chair Powell, why do you think meaningfully restrictive rates will drive inflation lower? The whole way monetary policy works is you create lower demand in rate-sensitive areas of the economy. You're talking about housing, investment spending. You and I have talked about that, right? Manufacturing. What does that do? It lowers demand for labor. That means it creates more unemployment, less inflation. So why are you keeping rates restrictive if, one, the labor market has no impact on inflation, and you don't want to see more cooling in the labor market? So anyway, color me confused and confounded and all of that with what happened at the Fed meeting.
Well said there. When you dive in like that, that's probably why the market did what it did. Sold off 3%. They're a little confused as well there. We're going to talk about. So last week we really dove into like CPI and that's the consumer price index. And last week the Fed's favorite measure of inflation, the PCE. What's that? What's that? Personal consumption expenditures came in. We can get to the weeds of it, so you can dive in. But I mean, you did some amazing work. It was up 2.8% year over year.
Core inflation.
Core. That's the one the Fed looks at. That's 80 basis points higher than the target, right? Or excess. Where's that coming from? You took a look, similar to last week's conversation. 26 basis points coming from shelter of excess there, and 36 basis points from financial service charges. In other words, if you're a financial person, you probably are charging your clients more. Why are you doing that? Because the S&P 500 is up 20% back to back. Not something that, people are probably crazy about paying, but hey, you know what? You're probably worth a lot more money, so maybe it's a good thing to pay.
I don't know anyone would be unhappy about the fact that the S&P 500 is up 20% plus this year.
And again, 36 basis points. That's let's be clear, 0.36% of that excess above 2% is coming from there. So again, most of it can be described by two things. Shelter, which is coming back. And let's be honest, if the market doesn't gain another 25% the next year, probably not going to do it. That fee should be lower. So that's important. But when you dug into that PCE, came in better than expected. It did spike a rally. You talked about it at the start of the conversation. You want to kind of put a bow on it? What'd you find there?
Look, if excess inflation was for reasons that were not literally what you just said, lagged shelter data.
Yeah.
Shelter is elevated because of what happened in 2022, not anything that's happening now. We know what's happening now. Private rents are going lower.
Yeah.
Right? Apartment list, what was it? About 18 months?
Redfin's 19, apartment list is 18. That might be reversed, but a few different places are saying something similar.
Negative year-over-year readings. Right.
Yep.
So that's coming in the shelter data. It's one thing if it's not showing up, but it is showing up. It's just showing up slowly. And then, like I said, stock prices pushing up portfolio management services. That's pushing up financial services inflation. That's not really like anyone's real expectation of, that's inflation. Right. I mean, you could talk about valuations and that's a whole other conversation. Right. You're not talking about valuations and things like that when you're talking about PCE inflation or CPI inflation. So it's one thing if excess inflation is coming from areas where we should really be worried about. But in this case, it's really backward-looking data, and I don't know what to say. I don't think inflation's a problem.
No, inflation's a problem when you have higher energy prices. All right. Crude oil's, the time we're doing, is less than $70 a barrel. Heating, gas. These things are not soaring by any stretch of the imagination. If it was a true spike in inflation, I think we'd like 22, for instance. What happened in 22? Well, we did have a little bit higher energy prices. To a degree. But the reality again is, hey, we're just not seeing that. Let's not forget, it was in 2008. We had a morning call earlier. I thought it was 2007, but 2008. Yeah. At the end of kind of that economic cycle of growth before the big trouble came, what was the strongest group? It was energy. Okay, crude oil's up $147 a barrel. Now that's not what caused the GFC, but maybe those high energy prices did kind of spiral and cause the first domino effect to happen. And you had the money markets breaking a buck back in March of 2008. You had obviously housing and subprime and all that stuff that happened. But you know what also happened? Crude oil was at an all-time high. And that might have upset the apple cart as well, pushing things down. Well, Sonu, I know we want to kind of wrap it up. I love this one, and this is another chart that Drew can share here. Looking at incomes, right? Disposable income, employee compensation, both are running substantially, in a lot of cases, above overall inflation. And that is why we haven't had a recession. You've shared this chart in multiple outlooks of ours, and it might be in the next outlook that comes out soon enough, no one likes inflation. People
remains the same, to use Led Zeppelin, title there. But no, look. If you think about the speed of the economy, we were talking about this morning in a call for advisors. Speed of the economy is essentially how fast consumption is growing. Consumption is growing pretty strong, especially over the last 3 months. Consumption's annualized real consumptions after adjusting for inflation, it's average just under 4%. That's really strong. That's insanely strong. Now, part of it is because a lot of people bought, SUVs and minivans and stuff over the last 3 months. So it came back, right? But if you think about what's the speed limit for the economy, that's how fast real incomes are growing. Employee compensation across all workers in the economy over the last 3 months has grown 6% annualized pace. PCE inflation headlines, so I'm including food, energy. People are like, oh no, why are you throwing that out? No. Just include all of it. Food, energy, all of it. Headline, PCE inflation was up 2.1% over the last 3 months. That gap is about 4%. That means real incomes are growing. There's a lot of potential there. And, that's why I think we've avoided a recession over the last couple of years, and why I think we'll avoid a recession. Take the worst case. Say the Fed doesn't cut. I don't think that's a base case. That's not what I'm expecting. Say the Fed doesn't cut in 2025. I think the economy still does okay. But, whether the Fed cuts or not, and whether housing and investment spending and manufacturing continues to be a little bit of a drag on the economy, that's going to be the difference between do we get 1.5%, 2% growth versus 2.5% to 3% growth.
No, really, really good stuff there. So again, if you look at headline PCE from February 2020, right before COVID, up about 19%, right? So prices up 19%. We're aware some are up more, honestly. Some are down, some aren't up as much, but 19 is what it comes out to. If you look at wages and compensation, I don't have them off the top of my head. You might, but I know one's up like 29% since then. The other's up low 30%.
Yeah, and the other comes up 32%.
So, nobody likes inflation up this much, but why have we avoided a recession? Net wealth's at all-time high, like we talked about last year. Stock market's virtually all-time highs. Your house is probably at an all-time high. People that own these assets truly have made more money, and then you look a little bit deeper, and you know what? Hey, most people have had a pretty good jump in pay, the last 4 or 5 years as well. And then we always hear, well, it's only the top 1%. No, that's not true. Lower income and lower overall net wealth people have had substantially higher percentage jumps. Now, yes,
a lot of them changed their jobs, and that's how they got higher pay. But the fact is, they did move jobs, and they got higher pay when they did.
Yeah. So it's just no easy answer here on some of this stuff, but that's why we've said there'd be no recession for 2 years now, and we're still saying there's likely no recession coming in 2025 because the overall consumer and consumer balance sheets and household balance sheets truly are still in really good shape when you look at debt to equity, because everybody talks about all the debt that's out there. You got to consider the equity part of things, and that is still really strong. All right, so anything else you want to touch on? Because that's kind of the slides and stuff we wanted to hit on. What else you want to talk about? Anything else?
No, I think the Fed is a risk here. I will call it is a risk because those are opportunities. And I think, frankly, the market post-election, we're looking forward to rate cuts and tax cut legislation, maybe, even more corporate tax cuts, things like that, right? I'm not saying, but none of these were a certainty, and last week was a reminder of that. We got a bit of a rude awakening that, the probability of these things are not 100%. But I still think we get tax cut legislation, Ryan, in 2025. I still think we get rate cuts. We just have to wait a while.
Well, hey, the good news is we'll keep talking about it.
Yeah, so I know. It gives us something to talk about.
Yeah, we'll be here. This is fun. Listen, this is, again, I guess this will be the last of the year, right? Yes. This is our last one of the year. Yeah.
No, isn't one coming out on the 31st?
Oh, is it 31st? My math wrong? Do I screw the calendar up? No, 31st is Tuesday, right?
Oh, 31st is Tuesday. Oh, so so this is
so anyway, so this is technically the last of the year. But we've hit some big numbers this year. So thanks to everyone who keeps listening to these. We'll keep doing them. You mentioned the morning call we did with our financial advisors, our Carson partners this morning. The stuff that Sonu and I talk about, we do a lot more behind the scenes for our financial advisors and our Carson partners and their clients. So if you are a financial advisor and you're out there and you're not happy with the big institutional place that you're at now that's just not giving you the same care and love and tenderness that they once did, check us out, carsongroup.com. Sonu and I'd love to talk with some other people. Love to talk to you because we are growing a lot, and we're going to continue to grow. We're going to continue to help people, help this industry, and help financial advisors find their freedom, make a little money, and keep their clients happy. That's what we're going to continue to do at Carson Group, and it's been a lot of fun. So check us out. And then next week's podcast will be with our buddy Phil Perlman of Pearl Institute. We're going to pre-record that, so that'll come out on the 1st, like normal. So if anybody knows Phil's awesome. He's a great guy to have on, kind of how do you make goals? How do you keep your goals? How do your brain work? All that stuff. I think it was great. He's going to be a good one. And we're recording that like in 2 hours, I think, right? 2 or 3 hours. So Phil's a good one. Any final words of wisdom, Sonu, as 2024, I guess, winds down?
No, thank you for your support in 2024. This has been a blast to do. I think our podcast listens and views on YouTube have surged, from beginning of the year. So keep tuning in, keep listening in. We'll be on top of all of this stuff we talked about. More to come. And definitely give the episode with Phil a listen on January 1st. I think that'll be a perfect way to start your new year.
And if you're getting together for Christmas, for the holidays, try not to fight, try not to argue. Everybody's still a little fired up about everything, but hopefully everyone out there has a fun, relaxing, enjoyable end of year. Enjoy some holidays, enjoy some good food, and then we all get back at it early January. So with all that, this was episode 115 of Carson's Facts versus Feelings, again titled, exact title? Did the Fed kill Santa? We don't think so. You can't kill Santa. You can't kill the Christmas spirit. You can't kill him. But anyway, with all that, everybody, we'll see you next. How about this? We'll see you next year. Sounds weird to say, but we'll see you next year. Thank you. Take care. Happy New Year, everyone. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.